Hey everybody, Marty Missouri here, 16th September 2022, Friday, with your weekly economic update and a quick stock market snapshot at the end. In front of you is our own general conditions index. Actually came up for the first time here in 9 weeks, still negative to the tune of 9 points, but off of a negative 13 last week. We'll look at a few inputs and we'll just jump right to it. Starting with retail sales. Headline off a little bit, year over year, up a little bit month on month, but of course it's core that everybody's thinking about right now, and that X's out food and energy, and that was flat on the month, although it was expected to be up 0.5%. Initial jobless claims continue to impress, just over 218,000 here this last week, and that's coming down for the 5th consecutive week, and that's a good sign because recall, as we've illustrated here, when you start seeing this move historically, recession tends to be in the near-term offering, which again is our base case, but this is an encouraging look. Continuing claims also came down a little bit, so that would be good news. Industrial production continues to slow, actually negative on a month-over-month basis, so that would not be a positive currently in terms of its what it expresses about the state of the economy. Commercial and industrial loans as well, slowing down a bit. Still not bad, but again, we're looking at the trajectory right now, and that would be clearly, that's negative overall. CPI came out this last week, and boy, don't we know it. The S&P dropped 4%, the NASDAQ dropped over 5% on this move. So headline CPI actually came down a little bit. It was expected to come down more, 8.3% year over year, 12 basis points on a month-on-month basis. Core CPI actually rose both on a year-on-year basis and on a month-on-month basis. Producer prices came out the next day, the PPI for final demand, negative 0.13%. Producer prices month over month, still up a whopping 8.7% on a year-on-year basis. Core PPI ex out food and energy up 8.8%. Baltic Dry Index measures or tracks the price of shipping goods across the world's oceans. Remember, it was declining like crazy. Big move up here over the last week. We're going to score that as a positive in terms of what it says about the state of the global economy. The NFIB Small Business Optimism Survey came out for August. Optimism ticked up a little bit, 91.8. Again, not anything to write home about, historically speaking, but it was an improvement month on month, as was hiring plans and CapEx. Let me just read kind of the summary from the report. The small business economy is still recovering from the pandemic while inflation continues to be a serious problem for owners across the nation. Owners are managing the rising costs of utilities, fuel, labor, supplies, materials, rent, and inventory to protect their earnings. The worker shortage is impacting small business productivity as owners raise compensation to attract better workers. Talked this week or wrote this week on the blog about sticky inflation, and that's the definition of that is higher wages, meaning once they go up, they tend to stick up there and they don't necessarily come down very rapidly, if at all. Rates of change can slow down in terms of wage increases, but we're looking at some pretty big numbers, across industries and sectors, and those are labor costs that ultimately have to find their way into the economy. Biggest concern, far and away, in the survey was inflation. And then lastly, the Economic Surprise Index. It's been very negative for quite some time here. You can see back, in June it bottomed out. Always keep in mind what this measures is actual data compared to what economists had forecast that data to show up as. And so when it's positive, and it's barely positive by 2 points, that means that the data have come in better than what economists had expected. And when it's lower, that means worse. Doesn't mean we're in an expansion when we're way up here. Could very much be in a contraction. Just the data wasn't as ugly as economists expected. And here, they were over optimistic, and then the data came in and it was bad. And that's, again, keep in mind, we ticked up 4 points, week over week. So our assessment shows improvement as well. But We're still, folks, pretty much in that recession camp, although we are presently, and I think for good reason, in the mild recession camp. And that also has an influence on where we think this market probably ultimately bottoms out. And we'll explore that here right now when we take our quick look at the stock market. Okay, so we'll start with the long-term chart, the monthly chart. Recall that when I showed you this 30-year analysis of the MACD sell signal, which essentially you historically don't have many, if any, false signals from this one, meaning when this thing rolls over, particularly from a high level like this, outside of recession, you can pretty much count on, at least historically, of course, not every bear market is the same, but historically, you find support. And here's just from the last bear market, when we're out of recession, which we are in here, and the MACD gives you a sell signal just barely there, look to bottom on the 50-month moving average. Boom, right? Sell signal finally bottomed here. That was a 16% decline. That was nearly a 20% decline. Sell signal, right? Intraday was over a 20% decline, closed down 19%. And then COVID, right, rolled over, ultimately bottomed right on that 50-month moving average. And here we are, folks, rolling over. Another 10% or so from this candle, I would say, would be where we would begin taking advantage of some of these values that we think are being created here as the markets continue to go down. The consumer stays strong. They still have a relatively strong balance sheet. We're not forecasting a deep recession. If we do change our minds there, then we're looking at much lower lows if history is our guide. Skip the weekly. It gives us basically close to the same price target there. Jumping to the 1-year daily, and then we'll finish up with the 60-minute chart. Still very much, have this sell signal going on in the MACD. Really nothing to write home about there, or nothing to get encouraged about there. You can see we almost came into a little buy signal here and then fell apart. Not a good sign, by the way. However, when we look at the relative strength index, we do have a bullish divergence because we have a lower low and we have a higher low here. Recall back in here as we were coming down to this trend line, we expected to get a bounce here, which we did. It was a nice bounce. Didn't quite get to, I talked about the 4,200 level maybe. This one, of course, was easy to call, as regular video watchers will recall, as was this bottom over here at 3,800, right? And so just the 200-day moving average needed to be tested again, and it was in all likelihood we thought that would fail. Since then, as you can see right in here, I'm sure we did this on a previous video, we had a descending wedge forming, did have this trend line right here to contend with as well, and then that strong support level, at least at the time, of 3,900. Bounced off of that, gave up the ghost here on CPI day, right, had that massive downturn, fought back a little bit the next day, still dancing on that trend line, and then gave up the ghost, to close out the week. Did find support right here, and I'll talk about kind of what we were talking about earlier this morning when we look at the 60-minute chart. So we'll see, folks, right here, 3,800 could be some pretty strong support. It would make a lot of sense to me because that was very strong support right in here. You can see that we tested that, looked like we broke down below it, but then continued and finally kind of bounced from there. It would make sense that the regret that was created here by folks who didn't catch that bounce might be thinking that that's a good level to re-engage, got a second chance, so to speak. We'll see. Our view is that ultimately we come down through there and even come in below the June low, which some people believe is in as the ultimate bottom. Our analysis says that probabilities are best right around 3,500 in terms of a sustainable bottom. And that's just based on what we know about the world and how we see it currently. Things can change, good or bad, between now and then. Yesterday morning, I drew my downward wedge here. I could check the one box in terms of the divergence here on the RSI. Still have this, and you actually have your positive divergence there, kind of a longer building one, and you have a nice move up here, almost a buy signal. And then here, so on a real short-term basis, this looks somewhat promising, and I do mean real short-term basis, obviously. So this morning when Nick and I were exploring this, I said on the hourly chart, looks interesting, if not compelling right here. And then we talked about the FedEx news yesterday. Their forward outlook is not positive. They're going to cut expenses and so on and so forth. And so futures yesterday evening on that news really rolled over hard. They'd stayed down. And I wrote about this in the morning note. So the thing about FedEx or that news is two things. Number one, FedEx issuing such a concerned go forward outlook speaks to what we talked about here, and that is the next shoe to drop being disappointing earnings because we think we're entering into recession or we're about to. And that we don't think the market accurately reflects even mild recession impact on corporate earnings. And so that announcement, the first impulse was bad news is bad news, right? But that's not really how the market's been trading. The importance of FedEx as an economic barometer or bellwether is also there. So our conversation this morning was about the market was going to kind of reassess that news from FedEx and say, hey, wait a minute, that is bad economic news, potentially disinflationary economic news. And if this is the beginning of a new trend, indeed, the Fed is not going to be able to or won't push so hard on the pedal to tighten monetary conditions and basically slow the economy in order to slow inflation. That's what the market has been reading out of every negative or potentially negative data point. So FedEx was both, right? It was that, the latter, but it was also the former. And that is an indication that corporate earnings are about to roll over hard. And that really is what we think makes, for the next leg down in this bear market. And then we begin forming a bottom off of that with the anticipation that the Fed's going to be able to ease off the gas a bit. So a lot there, folks. I know a lot to digest. Hope it's interesting. Hope it's useful for you. It's certainly useful for us. So for your clients, I know you rely on us to make these decisions based on how we view the world fundamentally, technically, and of course from a top-down global macro perspective. So as I continue to say here, there's a lot we like about what we see in terms of opportunities going forward with the longer-term outlook. Shorter term, it remains a precarious setup, and we expect lots of volatility. So again, we'll be here to report on it to you as we go. Thank you as always, folks, for watching and listening. Hope you have a great weekend. Talk to you next week. Bye-bye.